Hi, Brock VandenBerg, President of TaliMar Financial. We've reached September and now it's a sprint to the end of the year. I say sprint because historically, the fourth quarter has always been our highest producing quarter. In fact, last year, the fourth quarter accounted for more than 35% of our loan volume. In this update, I'm going to discuss a couple of topics. First, we're going to cover the state of the fund. Second, we're going to briefly discuss the market conditions and how those conditions could affect the fund. And third, I'm going to discuss what we should expect in the future. Before we jump into the state of the fund, however, I want to tell my investors to be cautious about what is being said in the media. Remember, this was the same media that told us millennials weren't going to buy homes because they preferred to be nomadic and rent. No, the housing market is not collapsing in the markets that we are lending. We know this because we compare the actual sales price of homes we fund with our fix and flip loans to what we underwrote, and the actual sales price is still higher. Please keep in mind the markets jumped over 30% in San Diego, and we knew that at some point that markets would need to cool and fall back to the historic mean. Markets like San Diego, Los Angeles, and San Francisco, and similar markets still suffer from a huge supply-demand imbalance, which means if people aren't buying, they're still renting. So no, I'm not concerned about the long-term value of housing in the markets where we are lending. August was another strong month for the fund. In fact, we accomplished several firsts, such as exceeding $20 million in total capital raised in the fund, $20 million in outstanding loans, and $1 million in total investor distributions. Additionally, we ended August with no late payments or maturity defaults. Currently, we have 31 loans in the portfolio with an active outstanding balance of over $21 million. The return to the investor after expenses is just shy of 8%. And the loan-to-value ratio is at 63.37%, lower than our 65% target. The makeup of the loan portfolio is 61% bridge loans, 35% fix and flip or fix and hold loans, and less than 5% in construction loans. We remain heavily weighted towards the single-family residential property type at 71% of the fund, with the next asset class being commercial at 25% and 4% for industrial. Our debt-to-asset ratio in the fund, or the calculation of outstanding debt to the total outstanding balance of the loans in the fund, is less than 1%, so the mortgage fund remains extremely liquid. Having some debt outstanding on the fund is advantageous because it allows us to immediately activate new investor capital versus waiting for the next loan to fund. It also reduces cash drag if proceeds from loan payoffs are greater than proceeds from loan closings in any given month. Currently, I'm looking to raise another $10 million for the fund by year end. This should be sufficient to handle the continued growth in our loan volume and position us to take advantage of the market going into 2023. Generally, I remain bullish on the market. Though we are seeing some signs of slowing in housing, it's too early to tell if the recent slowdown was the expected pullback from record sales coming out of 2021 or something bigger. As mentioned earlier, let's remember home values jumped over 20% in many markets and over 30% in markets such as San Diego. That appreciation didn't stop at single-family homes, but was experienced in other property types such as multifamily and industrial properties. In fact, the only property type that probably didn't see any appreciation was office. Let's also remember many markets that we lend in still have near zero unemployment, with many employers still having trouble hiring. And finally, the amount of equity homeowners have in their properties has never been higher. So I go back to my bullish sentiment. I am confident that many markets we target, the markets that we target in the fund, such as San Diego, Orange County, Los Angeles, and the Bay Area, all suffer from significant supply and demand imbalance. That is not going to change today, a year from now, or ever. Further, with employment levels so strong, the equity homeowners currently have in their properties, along with the extremely low interest rates many homeowners locked in on their mortgages, I just don't anticipate a flood of homes coming onto the market. In fact, I predict we see articles in the next couple of years how no one wants to sell their home because the rate on the mortgage is simply too low. As a result, we shouldn't see any meaningful supply of homes entering the market, which should buffer these markets from a serious correction below the mean. When I first put together this video, I was prepared to discuss how we should anticipate investor returns flattening around 8%. However, many news outlets are now reporting another 0.75 of a point jump in the Fed funds rate. Though investor returns aren't directly tied to the Fed funds rate, it does allow us the flexibility to raise rates on new loan volume. That flexibility, however, is dependent upon what other lenders do. My best guesstimate is that I anticipate the return on the fund to move up again closer to 8.5% by sometime early Q2 of 2023. Currently, we're placing loans in the fund at 8.5%, which has driven up the return from earlier this year, but still need to bleed off lower yielding loans that we funded late last year, have those either pay off or reset after an extension. As we plan for 2023, we anticipate placing nearly 100% of the loans we originate into the mortgage fund. The only reason we wouldn't be placing a loan in the fund is because it doesn't meet the requirements of the fund. That may be because that is an asset type that I'm not comfortable in the fund, the borrower doesn't have the experience or credit, or the property is outside of our target market. Either way, the mortgage fund has made the loan origination, closing, and servicing process much more efficient for my team. This has allowed us to switch our focus on handling investor wires, fractionalized ownerships, loan submittals, to more important tasks such as loan origination and loan servicing. Further, we've been able to provide our investors a much higher return, a more diversified investment portfolio, and a much more streamlined approach to investing in loans. I wanted to end our update with something another investor had mentioned to me. In speaking with him about why they invest in the fund versus individual trustees, they responded that it was because they earned compounded interest. As you're aware, our distributions occur on a monthly basis. For most investors, that monthly dollar return was never significant enough to reinvest in another investment. As a result, the funds remained in a low or no interest-bearing account. They were actually better off simply reinvesting the distributions and earning a return on that distribution the very next month. It had never occurred to me as a reason to invest in a fund versus trustees, but it's a powerful reason. Consider investing $100,000, which compounds monthly at 8% per year. In 12 months, the return isn't 8%, but rather 30 basis points higher, or an annualized return of 8.3%. I thought it was super interesting, and I appreciated the investor bringing that to my attention. I want to end this update with a thank you for listening. I want to reiterate how excited I am about the long-term trajectory of the fund. There is so much opportunity for our fund to gain market share and continue to drive investor returns higher. I understand that we've been inundated with negative information about the markets, but I remain very bullish about the long-term strength of the markets we are lending in. If you're interested to learn more about the fund or add to your investment, feel free to reach out to me or my team, or visit our website and follow the links under the Invest tab. Also, if you have not already, log into the lender portal to view all your accounts, their outstanding balances, and obtain updated information on the mortgage fund. I want to say thank you again for listening, and I look forward to hearing from you.